Hey there, Brian D'Amico here from VectorVest. In last week's video, I shared how I restarted my options income system. And I mentioned that the trade I used was called a credit spread, also called a vertical credit spread. Today, we're going to take a deep dive into what a vertical credit spread is and how it works. Even if you're new to options, you'll greatly benefit from this. After restarting my income system a couple of months ago, it's the trade I used to grow my account almost 10% with 10 out of 11 winning trades. After I made last week's video, Tom attended one of our coaching sessions and shared how pumped up he is about credit spreads. He said he has profited over $7,000 on credit spreads in the first 3 weeks of this year. He's done 33 trades this year, with 28 of those trades being winners. He sent me some of his trades, and we'll use a couple of his trades today as examples. Here at VectorVest, we feel it's important to learn how to use credit spreads if you want to learn how to generate consistent income. Let's start by looking at what is a spread. Two main components of options are the strike price and the expiration date. Most people who start with options trade a single option such as a call or a put, and it has a single strike price and a single expiration date. A spread is placed as a single trade, but it has multiple options in it, and you're spreading out the strikes and or the expiration dates. Think of it like spreading peanut butter over bread. You could spread the strikes vertically, you could spread the strikes and the expiration diagonally, or you could just spread the expiration horizontally. As the name implies, a vertical spread spreads things out vertically. Specifically, the strikes are spread out vertically. You have more than one option that have different strike prices, and both will have the same expiration date. This is the type of trade we'll be looking at today. There are other spreads, such as the diagonal spread, that spreads things out diagonally. You'll have different strike prices, but they'll have different expiration dates. Lastly, you have the horizontal spread, commonly called a calendar spread. Here you use the same strike price for your options, but the options have different expiration dates. Okay, let's dive deeper on credit spreads, which is a type of vertical spread. There are two types of credit spreads we'll use for income trades. One is called a bear call credit spread. The other is called a bull put credit spread. Today, we're going to focus on the bull put credit spread. Let's just break it down by looking at each word. Bull, put, credit, and spread. The first word is the word bull. That lets you know it's a bullish trade. You should place this trade when both the market and the stock are in an uptrend. The second word is put. That lets you know that this trade only involves puts. You'll be selling one and buying one. The third word is credit. That lets you know that you will be getting paid up front for this trade. And lastly is the word spread. That's just the difference between the strike prices, as I showed a moment ago, and it's the built-in risk management for this trade. And we'll talk more about that in just a bit. Let's draw this out so you have a better idea of what a bull put credit spread is. It all starts with finding a good stock, right? You find this good stock that's in an uptrend. And instead of buying the stock, which people do, they might buy it here, what you're going to do is you're going to pick a price that you don't think the stock will drop to. Now you might use areas of prior support, prior pivots, we use probability, but you're going to pick a price where you don't think the stock will drop to. And I'm going to draw that line, let's say right here. All right? That's the put that you sell. All right, so I'm going to put over here, sell, put. So that's the put that you're going to sell. Now, when you sell something, you get paid, just like in life. You sell something, you get paid for it. And I'm going to note that over here by putting a couple of dollar signs. All right, so $2 meaning you get paid for selling that put. Now, those of you who know a little bit about options, you might be thinking, but when I sell a put all by itself, isn't there a lot of risk there? I thought this was a low risk trade. Well, you're exactly right. And that's why you buy a put a little bit below the one that you sell. So I'm going to put a line here. You're going to buy a put down here. All right, so let's put buy this put. There we go. And think about that as your insurance policy. Now, just like in life, when you buy something, it costs something. So you'll use a little bit of the money that you received from selling this put. So I'll put that this costs $1 sign. And if you think about it, these two will cancel each other out, and it leaves you with a net credit over here. And by the way, both of these trades here, the selling of the put and the buying of the put, they are both done as one trade with your broker. For you, the mechanics are just as easy as buying a stock. For you to make money, the stock just needs to stay above this line right here. If it goes below this line, that's when you close it and you'll take a small loss. So the stock could go up and you make money. The stock could go sideways and you make money. And it could even come down a little bit and you could still make money. Think about that. You're starting off your trade with probability already on your side. Let's look at an example of one of my recent trades. I placed a trade on FedEx. Notice it's not a volatile stock. It's a company with good fundamentals, and the stock's price is in a nice uptrend. Let's compare buying the stock versus doing the bull put spread. If you bought the stock, the price of FedEx was $279. Of course, you could buy as many shares as you wanted to. No matter how many shares you bought, your risk would be this, because technically the price could go all the way down to zero. Okay, now let's build our spread. One part of a bull put spread is a put you sell. Let's say the put you choose to sell is down here. We'll talk more about which put to sell in just a minute. There are some people who just sell a put all by itself as their income strategy. That strategy is fine, but you need a bigger trading account, and it involves more risk, as you can see here. Selling a put means you're taking on obligations to buy the stock at that price. If the stock drops down to, let's say, $140 a share, and you have obligations to buy it at $260 a share, that would be a problem, and we don't like that. So instead, we teach you to sell a put spread. That trade still involves selling a put. However, at the exact same time, and on the same order, you buy a put a little lower. By doing that, you shrink your risk all the way down to this. Because buying a put gives you the right to sell a stock at that price. So even though you have obligations to buy a stock at this price, you have the right to sell it at this price, even if the stock was trading way down at $140 a share. I want to make sure you understand one thing. If you follow the rules that we teach, you will never have to worry about buying a stock. You will never hold these trades until expiration, and you will close a trade as soon as the price drops below this line right here. I'm only discussing obligations and rights just to make sure that you understand the trade. Another reason we like these spreads is the limited duration. The expiration you choose will not be way out in the future, which means your risk shrinks all the way down to this. Your expiration will be here, typically about a month away. The question now becomes, which put do you sell? Earlier we talked about picking a price where you don't think the stock will drop to. But do you pick this put up here? Or this one? Or what about this one? Or this one? Or this one? Or what about this one way down here? Well, the puts have prices. This put up here might be, let's say, $5 signs worth. This one 4, 3, 2, 1. And this one way down here, well, that might not even be a dollar sign. It might only be worth cents. Why is that? Well, since the seller is taking on obligations, and there's more of a chance the price will hit this line than this one way down here, he'll want to get paid more for that. So let's look at a case study of the put spread that I sold. I chose the 260 put to sell and bought the 250 put below it as insurance. Remember, both are entered on the same order, and the broker fills them both at the same time as one order. By selling the 260 put, I received $755 per contract. To buy the 250 put, I had to pay $476 per contract. Both were done at the same time. All I noticed was that I received the net credit of $279 in my account. My maximum risk on the trade was just the distance between the two strikes minus the $279 credit that I received. In other words, the max risk was only $721. Since there's a $10 spread and each contract controls 100 shares, 10 times 100 equals 1,000. But since I already received $279, the most I could lose is $721. Again, a special note. If you follow the rules, you will never incur maximum risk. Just like you would never hold a stock trade all the way down to zero and incur max risk on a stock trade, you will never incur max risk on an option trade as long as you follow the rules. Okay, let's quickly compare the two trades and see what happened. 1 week after entering the trade, FedEx rose 4%. So if you bought the stock, you made 4% return. During that same time, the spread hit its profit target. The profit target is defined as 50% of the original credit you received. Since I only traded one contract, my profit was $140 in that 1 week. You could trade more contracts if you wish. If you had done 10 contracts, you would have walked away with a profit of $1,400 during that week. So comparing the two, the spread had a 19% return compared to the 4% return if you had bought the stock. These are the trades we do every week with our coaching clients. Tom is one of them, and he's placed 33 of these credit spreads this year and has made over $7,000 in 3 weeks. Let's take a quick look at a couple of his trades. Let's look at these two because they are one of our most popular trades. They're done on the SPX, which is the index that tracks the S&P 500, which makes it simple for you because you don't have to worry about finding the right stock. You just trade the S&P. Here's what the SPX looked like on his first trade. Our market timing signal was bullish, so he did a bull put spread. Guess where his strike price was? If you're just looking at this chart, where would you think the strike price would be? Well, guess what? It was way down here. That's one of the beauties of the SPX. You could trade options way down here and still get paid a good premium. The put he bought as insurance was here. After he placed his trade, you can see the S&P went down, then it went up for a couple of days, then had a huge down day. But since his spread was so far away, he didn't have to worry. Then the market rose for 3 days, and his trade hit profits. So in just 10 calendar days, he walked away with $592. He turned right back around and placed another SPX bull put spread the next week because our market timing signal was still up. The put he sold was, again, way down here. Look at all of that room he has to be wrong on this trade. Here was his insurance put that he bought. And remember, both of those are done at the same time. The result came just 7 days later this time, and he walked away with another $590 paycheck. Let's quickly review some of the benefits of a credit spread. You saw today it involves less risk than buying a stock, which also means less margin is required to place this trade. It can be done in both small and large accounts. And best of all, when you place these trades the right way, you find you have 70 to 90% winning trades. They can be done when the market is going up. That would be the bull put spread that we looked at today. They can be done when the market's going down using the bear call spread. And since you don't have to be right on direction, you could still make money when the market decides to go sideways. Doing these trades can help provide a steady source of income. And if you start doing them on stocks and the S&P, you're now receiving income from multiple sources. Even if you don't need the income right now, these trades can help your account see consistent growth. If you want to learn the step-by-step system we put together to generate income using credit spreads and get results fast, the absolute best thing that you can do is register for our Options Paycheck course. Hands down, this is the best course to help you install an income system. In a matter of 7 weeks, you'll have a complete A to Z system to generate consistent income each month so you can live the lifestyle that you want without fear you'll run out of money. We'll start by building a strong options foundation. You'll know exactly how calls and puts work to confidently use them in your trades. In modules 2 and 3, you'll know how to create income trades that have a 70% or better success rate. In module 4, you'll know how to quickly find and select the best stocks and indexes to trade. In module 5, you'll know which stocks make the best option candidates and how to set up your trades. In module 6, you'll no longer be a deer in the headlights if a trade goes against you. You'll learn a trade management game plan so you always know what to do. Then in module 7, it's time to place your trades. You'll know exactly how to go to your broker and enter your income trades. This course is delivered live and via recording. So immediately after you order, you can begin going through all of the recorded course material. If you're a real go-getter, you can learn it all in less than 7 weeks. We've put everything you need to place the trade into a checklist so you never miss a step. If you're first starting out, it's always comforting having a security blanket to make sure you did everything correctly. We offer a 100% money-back guarantee on this course. You can go through the entire course, and if you're not satisfied that we taught you how to generate income using options, you can get all of your money back. This is completely no risk. If you're worried it might be too much, we're including this bonus. It's called the SPX Paycheck. This is where we take the entire course and we boil it down into something that you can do in 15 minutes a week. You saw how Tom used this SPX system to make over $1,100 in the first few weeks of the year. In addition to the course, you'll also get 7 live mastery support sessions. We'll be there every week to help you implement and guide you through the entire process. If you can't make those sessions, no problem. You can submit your questions ahead of time and you'll have access to a recording of the session. Plus, we'll also give you access to our members-only group coaching program. This is an exclusive group of our coaching clients where our options income coach, Ron Wheeler, shows in real time how he finds, selects, and sets up his option income trades. These are the sessions I attended to help me find my trades such as FedEx. So here's the opportunity in front of you today. We're going to roll up our sleeves and work with a couple of hundred people who are serious about generating income. Even if you've never had success with options, we're going to do this. If you want to join us and have us take you by the hand and help you install an option income system in your portfolio, the early bird price is $995. Price increases on Monday and registration closes for good on Wednesday. Simply go to www.optionspaycheck.com now and get yourself registered. Thank you for watching, and I wish you continued success in your investing.